Morning, everyone. David Moore with Equity Advantage and IRA Advantage, and we'll be getting started in just 1 minute. Thank you for joining us today. Hope everyone's doing well out there. Looks like another beautiful day, at least if you're in the Northwest. Hopefully wherever you are, it is too. All right, it's 10 o'clock. Thank you for joining us today. This is David Moore of IRA Advantage and Equity Advantage. Today's presentation is on contributions, distributions with your self-directed IRA 401k plan. Honestly, the title is not very inspiring, but we'll get you some great information out there, talk about a variety of things, how you get money into accounts, how you get it out, maybe how to diversify, believe it or not, out of your self-directed account back into Wall Street. We'll talk about contribution limits. Obviously, there's lots of crazy things going on out there in the world of tax reform, and we don't know where different things stand. So, even tax rates on different items, the initial proposals were to be retroactive to April of 2021. So, a lot of our 1031 volume right now, I believe, is in an effort to get things done prior to tax changes. Like I said, the initial proposals were retroactive to April of 2021. So selling things, realizing gain at this very moment, it's sort of up in the air with respect to what kind of tax consequence you're going to be looking at. If you've got questions on those issues, any of the tax reform proposals, you can take a look at our YouTube channel. Just type in Equity Advantage 1031 on YouTube, and you're going to see a variety of presentations on tax reform. Also, our regional CCIM chapter, we had a great presentation, I believe it was last week, provided by Jonathan McGuire at Aldrich Accounting. And if you're interested in getting some of that information, he's provided the slides from that presentation, the PowerPoint's available. You can reach out to Moore at 1031exchange.com, Moore at 1031exchange.com. And also, if you're looking for credit hours for today's talk, that's where you're going to be reaching to. Once again, Moore at 1031exchange.com. She'll be preparing any CE certificates needed. One last sort of housekeeping notice is that tomorrow, if you've got interest in reverse exchanges, we're doing same time, same channel on reverse transactions. We're very busy with them in this crazy marketplace. It's a great tool to at least get you where you want to go, sort of minimize the ID periods in that 1031, which anyone out there that's done an exchange understands that's the biggest headache in that space. So if you're interested in that, reach out once again to Moore at 1031exchange.com. She'll get you signed up and get you the information to log in, just as you've done today. But we're like I said, we're going to talk about a variety of things. First time I've given this presentation, I'm going to try to get things done timely. Probably going to be over, but the end of this presentation just includes some examples and then a glossary after those examples. So if you have to clear out at 11 o'clock, you'll have access to these slides. CC will be sending those out as well. And thanks for joining, and without further ado, we're going to take off right now. So contributions, distributions with your self-directed IRA or 401k. Should be a pretty quick talk, right, if that's all we talk about. We're going to talk about the basics of the process, what you can do with it. Like I said, we've got a half dozen examples at the end. We're going to talk about the pathway both to starting a self-directed account, whether it's IRA or 401k, We're going to talk about how to make additional contributions, what you can't do, when to make distributions, when you have to take distributions, and then obviously the contribution limits. So here we go.
David.
Somebody didn't get the notice I'm speaking. Anyway, my own people. So self-directed IRA, if you've been in my classes before, you know what I say about this. It's a self-directed retirement account it's not a legally defined term. It's just an account that allows you to do what you want to do. And in most basic sense, we're just going to move funds from a custodian. If we're talking about IRAs, we're going to move money from a custodian that won't allow you to do what you want to one that does allow you to do what you want. If you're talking about 401k plans, we're going to take a look at the plan, see if that allows you to do what you want. If it doesn't, maybe we amend it, maybe we replace it, but we'll talk about those things going forward. Self-directed retirement accounts are not new. They've been a possibility since the whole IRA 401k world came into being in the mid 70s. Really, the rules have not changed. It's just a very well-kept secret. But anything we're talking about today, nothing's new. It's always been possible. So it's not this new edgy deal that you're talking about doing. It's something that's been there for decades. And I think now in today's world, people are more and more concerned about obviously tangible assets, which are tremendous inflationary hedges. And we hear the ads on radio, we see the ads on TV for gold, silver all the time. And my background obviously with Equity Advantage over the last 30 years has been investment real estate. And that's it from a professional capacity. Before that, my brother and I actually flip properties. We wouldn't flip for flip's sake, but we do modified flips utilizing 1031. The reason we do that instead of just flipping property, if you've done one or two of them, you're going to get very tired of paying normal income tax on things. So integrating the refi and the 1031 ends up keeping your money yours. And that's what we're about in here. We like to say you've worked hard for your money. We're going to work hard to keep it yours. And whether you're talking about tax money out of your pocket, 1031 is going to get you there, or if we're talking qualified money, IRA 401k, if you've got questions, give us a call. We're going to help you out however we can. So I like simple. And then one of my buddies always said, oh, he loved the KISS principle. Keep it simple, stupid. And so if I'm looking at a retirement account, let me step back. If I'm looking at 1031, I'm looking at 4 basic issues. So, what do you have? What do you want? So whether items are like kind, we have to structure them as an exchange. For total deferral, you need to go across or up in value and equity. 1031 is not all or nothing though. So understand, every dollar you spend more than you want on something costs you a buck. If you don't spend it, maybe it's 30 or 40 cents, at least in today's world. Understand that we could be looking at, if this tax reform goes forward as proposed, I mean, you could have a federal tax rate as high as 39.6. So throw the state tax on top of that and the healthcare tax on top of that, and you're in the mid 50s. And that's a pretty scary thing. But in today's world, we're just looking at 20 to 25%, depending on whether gains appreciation or depreciation recapture. But 1031, we look at those 4 issues. It's got to be an exchange. Items got to be like kind. Net must satisfy the napkin test across or up in value and equity. And finally, we have to have continuity investing. If we look at a retirement account, I only have 2 primary issues I've got to look at. One, what do you want to invest in? And it's very, very broad. And the way the law works with respect to retirement accounts, if it's not specifically prohibited, it's therefore allowed. So with an IRA, you can literally buy anything other than collectibles, life insurance contracts, or stock in a sub-S corporation. So rarely ever is the investment a problem. What triggers problems is transactions between or for the benefit of a disqualified party. So, we like to say keep the assets away from the parents, grandparents, kids, grandkids, their spouses, or any legal entity owned in a controlling interest. Buy one of those. So, once again, what can you buy, or what are you going to buy, and who are you transacting between or for the benefit of? That's what's going to decide whether a given investment is going to fit your retirement account. Now, I mentioned that collectibles, life insurance contracts, and stock in a sub-S, that's with respect to a self-directed IRA. If we're talking about 401k plans, the only restriction is collectibles. So it's even more liberal than with IRAs. So as I said, IRAs, what's possible? If an investment's not specifically disallowed, it's allowed anything but the following: collectibles, life insurance contracts, or stock in a sub-S corporation. Now understand, and we've got a slide talking about picking custodians. Different custodians may have different rules on different things. And as I said in that first slide, that definition of a self-directed account, we all hear companies advertise self-directed IRAs or self-directed retirement accounts, but those are not truly self-directed. I mean, if it's being offered, at least at this point, there's no major players in that space that are going to be offering you the ability to go buy real estate or make loans, buy notes, buy crypto, those things with your retirement account, unless you have a truly self-directed account. When we're looking at a given investment, it's just got to be for investment purposes. You can't go out and buy a home for mom to live in, for example. That would constitute a prohibited transaction because mom's a disqualified party to your plan. All right. So these are the restrictions with respect to what you're going to buy. And if we're talking about a 401k, I mean, that definition of what's possible is restricted only to collectibles. So, I mean, that's a very, very broad menu of items you can go out and invest in. And as I said, it's just got to be investment purposes. Whatever you're doing is for an investment purpose, whether you're buying even a rollover business startup, for example, you're buying shares of a corporation ultimately with the plan. So that's an investment in the corporation. The corporation's then going to be employing different people. But we're not talking about rollover business startups today beyond a slide on that topic that I just always put out there because I just think it's a great story. But with respect to a given restriction in investment with a 401k plan, typically those restrictions are going to be based upon the plan document or the trustee or administrator, what they're going to do. And believe it or not, I've done a fair number of these where what I want to see, if somebody's got a question for me, whether a 401k plan can do it, I typically direct them to look at the plan document and any investment restrictions that might apply. If they can't find it, they'll send it to me. I take a look at it. And there's a lot of times where the plan actually does not have the restrictions that our investors have been told. So our typical path on a 401k plan is to review the plan, see if it allows the investment that the person wants to make. If it doesn't allow the investment the way it is, can the plan be amended to allow it? If it can't be amended to allow it, that last step would be to replace it. But you're also going to be looking at the administrators and what they're going to want to be able to administer as far as the plan and the assets in that plan. If you're looking at a solo 401k, for example, a single participant, or it could be a participant and his or her spouse, that would be something where typically you're going to have a bank account. We're going to talk about it further later. You can have a bank account in the plan's name and EIN. If it's your 401k plan, you're the trustee of the plan, you've got the power of the pen. So anytime we're looking at truly self-directed accounts, if there's really a downside to them, is that you have to be careful. I mean, with a Wall Street IRA or 401k, I mean, you can make a poor investment decision, but you're not really going to be capable of making a prohibited transaction. If you've got a truly self-directed account, you have the ability to do that. You have the ability to do the wrong thing. Even with a basic self-directed IRA, which every investment has to be submitted to the trust company before being made, approved by the trust company. And by the way, that their approval is not based upon whether the investment is a good one or not. They're just going to approve or disapprove a given investment based upon what their perception, whether it fits or does not fit. If it constitutes a prohibited transaction from what they've been presented, they're not going to allow it. But really, they're sort of that gateway, a layer of protection. If we've got a checkbook IRA or a solo 401k plan, on the other hand, you've got the keys to the castle. You've got to really make sure that every time you pull out that pen to make an offer on something, buy something, do whatever you're doing, what are you buying and who are you transacting between or for the benefit of? Those are going to be those two issues that are so critical that you review and understand. So, what do I mean about who you're transacting between or for the benefit of? We talk about disqualified parties in the IRA 401k world. We might look at this a similar list if we're in 1031 with respect to related party transactions and different rules that apply in that space. But if we're looking at disqualified parties in the IRA 401k context, it would be any individual member of your family, as I said earlier, the parents, grandparents, kids, grandkids, their spouses, or any legal entity owned and controlling interest by one of those are all would all constitute disqualified parties to your IRA. Now, obviously, you're a disqualified party to your own IRA. Your IRA would be a disqualified party to a Roth IRA, for example, if you had two of them. Each of those accounts are disqualified parties. Now, what's interesting is you can't transact between or for the benefit of a disqualified party, but you can transact along with a disqualified party. So if you said, David, I'm interested in adding money, for example, I've got a transaction we're working on now. It's something that we put together, I don't know, 3-4 years ago now, and it was a property acquired via 1031, tenancy in common, and the tenancy in common structure is necessary if we're aggregating a group of people into a given investment with 1031. You cannot exchange into or out of a partnership interest. But in this scenario, what happened is the property went away. The people that owned it owned a tenancy in common. We completed their exchanges into a replacement property, and actually it was previously been a retirement center, but we ended up doing a tenancy in common structure into that thing because that's what 1031 required. And then the people that had been part owners of that relinquished property, actually with IRA or 401k funds, their money just went to them upon disposition. But on the upside, the up leg, what we had to do with that money is we were doing an improvement exchange, so we had to complete the acquisition and get our 1031 clients taken care of. So we pulled out all that IRA 401k money, used it as debt on that property, which allowed them to go vertical. And then at a later date, those notes from those retirement accounts were actually converted to a membership interest, convertible notes into a membership interest in a new LLC that all the TIC owners actually contributed their shares into also. So we ended up converting the nature of the investment for those clients. But the idea is, in that case, if we want to combine money, plan money, and personal money into a common investment, we can do it either tenancy in common, or we can do it as common members of an LLC. The 1031 in that scenario required the tenancy in common structure that the qualified money did not. But once again, I want to stress, you can transact along with a disqualified party. You just can't transact between or for the benefit of one. So keep that in mind, and there's many scenarios where you say, hey, I've got X dollars in my pocket, I want more, I want to have some qualified money into this given investment. Maybe that bumps you up to a level where you've got the capital to make that investment you truly want to. And just as like I said, you could have personal money and plan money in there, you could have your traditional IRA money in there, you could have Roth IRA money in there as well. So why a self-directed account? I love roller coasters. I grew up in Santa Cruz. The boardwalk had the Giant Dipper, which is an old wood style. We also had the Wild Mouse that actually ended up, it was called, actually it was replaced with a Jetstar, but the Jetstar is the one that ended up at one of the Enchanted Forest, actually, outside of Salem. It was funny to see that for years. But people want to get off the stock market's roller coaster. I mean, the thing is, real estate's not really considered to be a liquid asset, and since it's not necessarily a liquid asset, it suffers much less in the ups and downs. It's much more stable. The stock market, you just think of what's happened within the last couple of weeks. It's always going up or down, and that ultimately leads to some stress when looking to go to cash to move funds into a self-directed account. But they get off the stock market's roller coaster, greater financial control, invest in what you know. I mean, that's a big item. If you've got specific knowledge on something in Wall Street, you can't legally use that. You can. If you're a mortgage broker, you want to make loans for a living, you do that, and you want to make loans with your retirement account, you probably have an advantage there. It's probably a very low risk situation, and you can actually do that if you'd like. Increased investment flexibility, real investments, not alternative investments. So it's interesting, anything that I would consider a real investment is considered an alternative investment, anything that's not necessarily sold by Wall Street. So whether you're talking crypto, that's maybe not a great example, but if you look at gold, silver, any precious metals, you look at just any tangible asset. Real estate's the ultimate tangible asset, which is an inflationary hedge, in which those things are very important in today's marketplace. don't think your property's gone up 25% in the 6 months. We've got some inflation there, but that inflation, is going to be a much more easily thing to deal with if you're looking at nice tangible assets. Community-based investing, go and make a difference where you are. I mean, that's one of those benefits. You don't just have to throw the money in Wall Street and have it impacting other people, other places. If you want to make community-based investing, you can do that. You can make a difference locally with your retirement account. Opportunities, obviously, if you've got, depending on what type of retirement account, if you've got a basic self-directed IRA, it takes a little bit of time to make an investment. If you've got a checkbook IRA or a solo 401k, any investment is just literally a check away from being made. So they're very easy to use, very fast investment, and great liquidity on stuff. Tangible assets, like I said, great hedges against inflation. Security, what do I mean by that? Have things that are hard assets that you've got more control of. Put it where you know it is. You can once again feel better. Even if we're talking about a solo 401k or a checkbook IRA, you're literally putting the money in a banking institution of your choice wherever you want to do that. You're not dependent upon a trust company halfway across the country to hold your money or something somewhere else. So if you want to do things all local, keep it where you are. That's all possible with self-directed accounts. The course of your future Robs. So in recessionary times, seems like we do more and more Robs. So Robs, by definition, is a rollover business startup. And so if you look at straight up, you ask somebody, can I use my retirement account to go buy a business and go work for it? And the typical answer is going to be no, you cannot do that. And IRAs are not going to work in that scenario at all. But a rollover business startup is a combination of a 401k plan and a C corporation. So we can actually create a new business that, using your retirement account that you're actually working for. So that's been something that, and the franchise world understands that, and so a lot of franchise companies these days are pushing rollover business startups. But we've done everything from mattress companies to Alaskan fishing operations, car dealerships, all kinds of different things out there. And if you've got questions on any of these topics today, don't hesitate to reach out after the seminar, or if you've got some questions, we have some time at the end, we might get to some questions. But the only dumb questions is the one you don't ask, right? So if you've got some ideas, roll them past us. Let's see what we can do for you. Common objections. So, like I said, when you're looking at a Wall Street IRA 401k, the money's with that institution. It's in Wall Street. You're directing somebody else, even if it's a self-directed account, you're going to direct them into what funds you want to buy, what stocks you're going to buy, so on and so forth. They're not going to allow you to go buy things outside of Wall Street. Now, when you talk to some of these people, a lot of times they're thinking, well, gee, I've been doing well with your investment portfolio for the last couple of decades, and you shouldn't take the money. And what do you mean you're going to take it out? And I want to stress that this is not an all or nothing situation. If we're talking about IRAs, if you've got a solo 401k, I would shove everything into it, obviously. But if we're talking about IRAs, it's not all or nothing. Move what you want to use in the self-directed account, keep it going that way, keep your Wall Street stuff where it is. Ultimately, we're just talking about diversification. A self-directed account is ultimately just going to give you the ability to diversify outside of Wall Street's offerings. And so these are common fallacies in this space, things I come across all the time. First one, loss of long-term capital gains tax rates. Well, as I said, we might all be looking at that in another couple months, or if this tax reform gets passed. But the way it is today, I mean, that's not a false statement. I mean, you would lose if you're putting real estate in your IRA, you lose long-term capital gains tax treatment on those things. But there's nothing in your IRA, really, it's a moot point, because there's nothing, absolutely nothing in your IRA that's going to get a long-term capital gains tax rate consequence anyway. It's all taxed, it's normal income upon distributions. So although that statement is true, and if you're asking, well, gee, David, am I better off pulling money out of my pocket to go buy the property or whatever it might be than using my retirement account? If you could only do one or the other, I'm going to say yes, pull the money out of your pocket. I mean, you don't need non-recourse debt. You've got long-term capital gains tax potential on things. You can work on the property. You can take the cash flow. At the end of the day, you can pay the tax, or you can do a 1031 exchange. So by all means, if it's only one or the other as a source of funds to get something done, use the money out of your pocket. But if you're looking at your retirement account and say, gee, I want to diversify outside of Wall Street's offerings. And by the way, at last count, 2% of IRA 401k funds is in real estate. So, you know, and probably a bulk of that is in real estate investment trusts, which are stocks. So, I mean, we're really just talking about diversifying. A self-directed account is going to allow you to own everything you currently own, plus anything else the law allows. So loss of long-term capital gains tax, true, but anything you buy with a retirement account is going to have the same tax treatment, so it's a pointless statement. Cannot be leveraged, so that's our second one. Totally untrue. All right, you can leverage any investment with an IRA 401k. I should say any. It's going to be a lower loan to value. It's got to be non-recourse debt. What I mean by a lower loan to value, maybe you're looking at 60-65%, and there's very few sources for that stuff out there. You can type in myiralender.com, iralending.com. We're going to talk about this topic a little bit further deeper in this presentation. What about RMDs? Since real estate's not liquid, what's an RMD? Required minimum distribution. So, that's part of this presentation's title. So the idea, the issue with the lack of liquidity is what happens if you get to 59.5, or you want to take something out, or if you get to 72 and you've got to take the RMDs, and let's say you don't have any money to take that RMD, and the idea is, well, gee, real estate's not liquid, you don't have the cash to take the RMD, you're going to have a penalty. Well, just take an in-kind distribution. Something is wonderful today. So you can take if you want to own a piece of property, you can take the whole property as a distribution given year, or you could do a tenancy in common interest in the property. A minority interest in today's world could actually be discounted. Now, that's something we're going to talk about later, but it's something also on the chopping block with Biden's tax reform. So these things are all really on the edge right now in today's world. And there's different things that you should be probably talking to your tax people about before year's end, even though, as I said earlier, any tax law changes look to be retroactive to April of this year. I doubt that's going to happen. Yeah, but work with your tax people, get good tax people. They're really critical to your life. All right, so that RMD, if you don't have the cash taken RMD, simply take an in-kind distribution, which ultimately gives you ownership. If we're talking about conveying ownership of a property, it can be tenancy in common, or by simply assigning a membership interest in a limited liability company if that asset owns the property. Lose interest deductions, depreciation. Well, that's true. Once again, but really anything you're buying with an IRA, you're not going to have those things anyway. So once again, why pick on real estate? You're going to have the same issue with anything you buy with a retirement account. One comment about that last statement. You've got to understand that if you use your retirement account to go buy something, you don't own it. The retirement account owns it. And I always jokingly say, well, yeah, it's not mine, it's Susie down the streets. All right, that's the best way to look at these things. Look at your personal money, that's yours. Look at your IRA 401k funds, whatever it's buying. If you got a self-directed account, just think of it as somebody else's, and you're really going to save yourself the opportunity to have a problem by doing so. So what kind of retirement accounts qualify for self-directed account? Well, if you're happily employed and we're talking about a current employer plan and you're under 59.5 years old, you're stuck. I've had people quit their jobs or step away from their job for a period of time to get access to their money. If you're under 59.5, if you were to quit work for that job, you would have access to those funds. At that point, you could move them into a new 401k, or you can move them into a self-directed IRA. But 401k plans or any business corporate plan, we can typically self-direct those things. As far as IRAs are concerned, we can do any IRA. But once again, with the 401k plan, if you're happily employed, current plan, under 59.5, we're going to be stuck. Previous employer plans, we can move. And if you're over 59.5, you can obviously move. And once again, it's not all or nothing. Move what you want to use in this capacity. So this should answer questions on what type of accounts can be sourced. for your self-directed retirement account. So if we're talking about IRAs, and once again, that first slide, we were talking about the definition of a self-directed IRA. And I mentioned, well, really what we're doing is just moving funds, if we're in the IRA space, from a trust company that won't allow you to do what you want to one that does. And if we're talking about IRAs, I think once again, it's important, move what you want to use in the self-directed capacity to the new account, keep your Wall Street stuff where it is, because you've isolated those two accounts. But if we're looking at custodians and trying to pick a custodian, I mean, there's a bunch of them out there. Type self-directed IRA or self-directed custodian trust company on on Google or YouTube or anything else out there, Yahoo, and you're going to see a variety of companies out there. Now, as I said, some of them are going to call themselves self-directed custodians, but they're not. But truly self-directed custodians, big ones in that space would be Equity Trust, SunWest Trust. I mean, Pensko's gone through a variety of name changes. I don't know if they're Opus these days. IRA Services is now Forge Trust, but they've changed in names. My first off, I'd say understand how long they've been in business, that history stuff. Understand what type of investment limitations they may have, if any. Understand if you're using a checkbook IRA or IRA LLC, what limitations they may have. Now, some trust companies won't allow you to be the manager of that limited liability company. Therefore, you lose the power of the pen, and it totally defeats the entire purpose of a checkbook IRA. So you obviously don't want to use that trust company if they're making somebody else be the manager of the LLC, limiting your ability to access the funds. There are trust companies that will also require a third-party review of the LLC's activities in a given year, because really their concern is that if you've got total control of this stuff, you have the ability to screw it up. There's no safety net, and they want you to know somebody's looking over your shoulder. So investment limitations, checkbook IRA, LLC limitations, what they're going to allow as far as whether they allow a checkbook IRA, whether they allow you to be the manager of that LLC, what kind of requirements they have with respect to that. Customer service. Now, customer service is a whole nother topic, right? I mean, customer service seems to be one of those things that keeps getting smaller and smaller and smaller. Everybody's getting squeezed these days. And so if you look at the volume of business in a given business, if you look at the trust companies right now, I mean, they're buried in stuff, and it's hard to keep up with what's going on. So, who answers the phone? Do you have access to people when you have those questions? We're not a trust company. We're an IRA 401k facilitation company. So, we're here to answer questions, help you get where you want to go. As far as the trust companies are concerned, typically think of them, more like a bank. You're asking them to make investments on your behalf, or you're wanting contributions or distributions made. But as far as interactivity with that trust company, if you've got a basic account, you're in touch with them all the time. If you've got a checkbook IRA, you've very much restricted your interaction with them. So you're not at the mercy of what's going on. But their customer service is actually something that's obviously very important. Cost of that trust company. Don't just think of the cost that's there. Understand how they're charging you. All right, and you've got to make sure that what you're paying for is going to be taking care of you, and you might be able to get some very inexpensive trust company. Do they answer the phone? Do they answer any questions for you? Do they expedite things? Do they, how quickly are they going to process an investment authorization? If you've got a basic account, even though a trust company might have, let's say, a 24-hour or 48-hour funding policy that if you expedite the investment, you talk to people in the space, and they're going to tell you that typically is not going to happen. I had a meeting, this is probably 15 years ago now, with one of the owners he's now retired, but he was the owner of one of the largest self-directed trust companies, having dinner with him, and we talked about basic investments. We talked about a basic self-directed IRA. We talked about checkbook IRA, and we're having dinner. He said, "Well, I don't understand why you guys think checkbook IRAs are so important." And we've got a 24-hour funding policy. And I started laughing. I said, "Well, when was the last time you used your company to go buy something?" And that's just not the way it is. So checkbook IRAs literally give you the tools to make the investment you want when you want. And you've just got to understand different trust companies have different policies with respect to all those things. The cost, obviously the custodian charge in and of itself, but also how you're charged for this thing. Are you charged based upon the value of your account? Are you charged based upon the number of investments you're making or holding? What's happening with that? What's the charge for an investment? But there's a huge difference, and I really steer my clients away from a company that's going to charge you based upon the value of your account, because in a self-directed world, I mean, if you've got Wall Street investments, you've got a stock ticker price, you can see every time what that thing is on a given date. There's no discussing what that thing is, or date or time actually. But if we're looking about self-directed account, what is property worth? I mean, it's going to be highest best use. I mean, and how do you measure that? And with some of these proposals, with tax reform, once again, they're talking about going mark to market. What is something worth? How can you charge something based upon something where you haven't actually realized the gain? So, you know, my youngest brother's an MAI appraiser. That's sort of the top of the appraisal heap. And, you know, I'll joke with him sometimes, hey, Greg, how do you know what something's worth? Or how do you know when you've done the right job? And he says, well, that's pretty easy. Nobody's too happy or too mad. You know, buyers and sellers agreeing to things. So highest best use, it's going to be worth more for one person than another. And if you're sitting there arguing about the valuation with the trust company, especially when you get to RMDs, this is a critical issue. So, you know, my position on these, and you're going to listen to your own heart, but I would prefer to work with somebody that's going to charge me based upon, what I'm, you know, the number of investments maybe. And keep in mind, a checkbook IRA, you have one investment. So that's why I really like checkbook IRAs. Finally, history in the business. You want to know they've been there, they've been through good times and bads. And, you know, times like we're in a pretty frothy market, we have more and more people coming into play in different aspects of the real estate world. And, you know, that sort of thing's happening in other businesses too. But you want to make sure you're working with somebody that's been through a bad time and is prepared to go through another bad time, as well as the good times, right? So as far as establishing these things, we're just moving one trust company to the next. If it's an IRA, I mean, you can, lots of trust companies these days, you can go fill out forms online. I mean, if you're working with us, we're going to want to copy your current account statement. We're going to want to, you know, photo ID. We're going to fill out some forms based upon your information, personal information, and as far as account information is concerned. But it typically takes 2 to 4 weeks to get this done. And the bulk of that time really is moving that money from one place to another. But if it's custodian to custodian, it's pretty easy. When we establish a new custodial account, one of the forms we fill out is a transfer authorization form, which allows the new trust company to go to the old one, say, hey, give me the money. Your responsibility is to make sure you're in cash at that old trust company. If you're wanting to move items in kind, it's more cumbersome. We have done that and we do that, but you know, it's much easier if you go to cash. So the biggest issue you're going to have is when to go to cash. And that's a tough deal because day to day, hour to hour, minute to minute, stocks change. And so that's the issue that our clients wrestle with probably more than anything when they've decided they want to self-direct, is when to actually go to cash to move that money. So a basic account, we're just moving money from custodian A to custodian B to make an investment. You have to submit the investment to the trust company. As I said, timelines are often critical. If we're, you know, dealing with somebody that wants to go buy an auction property with a retirement account, they've got to have funds, you know, accessible at that moment. That's not going to work with a basic account. So most of the time, if people are active with their investments, we're going to do what's called a checkbook IRA. We're just moving funds from whatever source the money is into the new custodial accounts. If you've got Roth and traditional money, it's going to require 2. And then we'll then direct the trust company to make an investment into the new limited liability company, which you're the manager of. So the member of the trust company is going to, or the IRA LLC is going to be the trust company for benefit of your IRA or your IRAs or your IRA and your spouse's IRA, you know, whatever it might be. But the member is going to be the trust company. The manager is typically going to be our investor. Unless you're working with a trust company that won't allow that to be done. And as soon as the investment in that LLC is funded, you've got the power of the pen. You're just going to write investments as you normally would buying for yourself. I mean, it's a simple process. Works very, very well. As far as contributions right now, traditional IRA, just a basic traditional IRA, you're looking at $6,000 2021 if you're under age 50, max of $7,000 if you're over age 50. Roth contributions. I'm not going to go through this chart. I don't have time. You're going to get it. But it's based upon your income, and really, if you make enough, you're not going to be able to make any contributions to Roth. So it's income dependent, and this chart gives you the max that you're able to at different income values or income amounts. So how do we do it? All right, so just as we're funding a self-directed IRA, as I said previously, the money's going to go from trust company A to trust company B. You could literally, if you're really concerned about getting an account set up quickly, I mean, you could tell your trust company to liquidate everything and just give you the money. And you'd have 60 days, if you haven't taken any money during that given year, you'd have 60 days to get it back into an account. And by the way, we've actually used 60-day rollovers to fund reverse exchanges too, because if people want to buy it before they sell something, they have to have the financial ability to do it. We've had clients that we've just used that 60-day rollover to get access funds, make the acquisition via the reverse exchange, and then they get the permanent financing in place, get those funds back in their retirement account. So if we're looking at a 60-day rollover, you can literally take the money, move from one trust company to the next. If you're looking at establishing a new account, it's going to go trust company to trust company. If you're making contributions, this is a common problem, okay? Contributions or distributions to a checkbook IRA. Often people will just write a check to the limited liability company. That cannot be done. The funds have to be deposited with the trust company. The trust company then makes an additional investment in the LLC, funding the LLC's bank account. So any contribution has to be made through the trust company into that, ultimately back into the limited liability company. Now, any distribution, people do the same thing once in a while. They would write a check straight from the LLC to them as a distribution. That's not okay. That's a prohibited transaction. So distributions must also flow from the LLC back through the trust company to the individual. Now, one of the trust companies we work with has a IRA contribution distribution correction form, and that's aimed at sort of fixing that problem that was there. So once again, we're talking IRAs, money has to flow through the trust company, whether it's going in or going out. Now, if you look back at that last diagram for the checkbook IRA, I don't remember if you remember the bubble diagram there, but it showed the source funds, the trust company, the LLC, and then the ultimate investments off to the right side. We're in a situation where people will just directly go in and out of that LLC, which is not okay. Everything needs to flow through the trust company, whether you're making a contribution or a distribution. Now, if we've got a multi-member limited liability company, now, as I said previously with prohibited transactions between disqualified parties, it's prohibited transaction to transact between or for the benefit of disqualified party. It's not a prohibited transaction to transact along with. So if we create a checkbook IRA LLC that has you in it, as well as your IRA, or let's say you've got traditional and Roth funds in that account, maybe you and your spouse have your respective IRAs in that account, the initial funding of that investment in the LLC is going to be fine, but we cannot have additional investments into that LLC after it's been funded. That would constitute a prohibited transaction. So when we create a checkbook IRA, if we have multiple members that are disqualified parties, and you said, gee, David, I need $100,000 to make this investment. If we're talking real estate, I'm going to tell you, let's put 125 in it or something, because you need to have enough to make the investment and cover any dark day that might occur, because you can't just add money to that account at a later date. If you don't have all the cash available at the inception of that checkbook IRA LLC, maybe we'll have some additional funds coming in. The operating agreement will address additional funds over maybe a couple of weeks' time. That would be, you're going to receive an additional membership interest attributable to cash, and also a note, let's say, that's paid off when those funds are available in the future. But when you structure these things, multi-member with disqualified parties, it's a static entity. If it's a single member or an LLC with non-disqualified parties, you can always make additional investments into the LLC, but the funds have to flow through the trust company to do that. So they're actually making an additional investment in the LLC, or you're making a distribution from the LLC back through the trust company to wherever that money's going to go. I actually had a transaction a couple of years ago where we'd put a checkbook IRA together for a client, and that client passed away, and the lawyers that were overseeing the estate just directed the people that inherited all this stuff to just liquidate the LLC and take the money. Well, that's prohibited transaction. That was not the right thing to do. You can't do that. The IRA ends up becoming a beneficiary IRA, and you would just take distributions as you normally would. If you don't like that self-directed account, you would liquidate all the assets in the LLC, shut it down, funds go back to the trust company, and then move it back into a Wall Street IRA, I guess is what typically would happen if the heirs don't want to deal with the self-directed account by itself. But it's important that these things are dealt with correctly. Don't pay somebody to learn on your behalf. It's complicated stuff. Pay people that understand what's possible and know, and you're paying them to get something done instead of to learn on your behalf. So I pretty much covered this. The one thing I didn't say is if we're looking at diversified portfolios, and ultimately that self-directed account is there for that reason. You're just going to diversify outside of Wall Street into additional items. Once again, it's not all or nothing. But a typical scenario is if you've got a checkbook IRA, you've got real estate. I like to say ultimate tangible asset, gold, silver, you're still betting that thing goes up in value, or you've got inflation there it's going to take care of. That's your yield on investment. With real estate, obviously, you're not banking on appreciation. I was taught never to bank on the appreciation, but you're going to have other things there. You've got tenants buying the property for you, at least historically. Maybe right now they're not, but historically that's going to happen. So the IRA, that's a great investment. It's going to realize at some point you're going to own the thing, and you've got money piling up in this account as the rent comes in or whatever yields come in back to that self-directed account. If you want to take that money, leaving it in the bank does nothing for you today. So if you want to move that money, either take a distribution of it, once again, it's going to go from the LLC through the trust company to you. If you want to move the money back to Wall Street, there's two ways to do it. One, simply open a Wall Street account in the LLC's name and EIN. That's the easy way to do it. Rarely in life is the easy way to do something the best way. So the other option is to move the money back from the LLC through the trust company back to a Wall Street trust company. And the benefit of doing that, even though it's more cumbersome, is you've isolated those two accounts. If you commit a prohibited transaction on the self-directed side, it's not going to encumber your Wall Street stuff. If you simply open a trading account in the LLC's name and EIN, you do something in the with a self-directed account that's a prohibited transaction, you've now encumbered everything that LLC owns. So once again, rarely is the easy way the best way, and this is yet another example of that. Do it the right way. Move the money if you want to diversify, keep things protected. Move it through the trust company, from your LLC, the trust company, back into Wall Street. Solo 401ks. Why would somebody want a 401k? Typically you're looking at 401k as a plan account, but solo 401ks we do a lot of times for real estate brokers. They're good for an individual and his or her spouse, if the spouse is also working in that firm. So we've got lots of real estate brokers. Their spouse works with them to some extent. So we can do a single 401k plan and have two participants in it, and they're just wonderful because really, you don't need a trust company. The reasons we like these things, you can make, you can't fund that new solo 401k with a beneficiary IRA. That's one that's been inherited, or Roth funds, but you can do a Roth conversion of the funds in the 401k plan. You've got increased annual contribution rates. We'll talk about those in a second. No UBIT on leverage. You've got the ability to go out and buy leveraged investments without tax exposure. We'll talk about that in a second. No custodian. You can invest in life insurance, S corps, anything, literally anything other than collectibles. Borrow money, half what's in it to a max of $50,000. You can't do that with an IRA. And you're literally going to have, like I said, a bank account in the plan's name and the EIN. You're the trustee of that account, therefore signer on that account. You can just go write a check, or it's just like a checkbook IRA with respect to making investments. As far as, is there a downside? I think they're great, but 5500 EZ is only, that's the reporting, that's only necessary if you've got in excess of $250,000. There's some administration costs. Very little actually if you don't have other employees. Now, if you hire an employee, then you've got to allow them to participate in the plan then, and you're going to need a TPA, a third-party administrator, if you hire anybody and they're now participating in the plan. So typically, if it's just an individual and his or her spouse, they don't need that TPA. If you have any employee participants, you better have one. It's really to cover your tail. And really the cost of keeping these things going is very low. You're just looking at the cost of annual amendments or restatements, and if you've got in excess of $250,000 that form $5,500, and they're just wonderful. So contributions, you got two different types: elective deferral, 401k, also known as employee contributions. You've got set 19.5 at 2020 at 26,000 if age 50 or older. You've got elective deferrals that remain the same. You can see that. Profit sharing, you've got the ability to get way up there. So you're talking mid-high 50s as max contributions. It's very similar to what you'd be looking at with a SEP IRA. So SEP IRAs are something that's your, I guess, IRA equivalent. If you've got a business and you don't want to have, if your tax and legal people have said, hey, you don't want a truly self-directed 401k, it's going to be too much liability for you, which is a position that the tax and legal community takes sometimes if you're talking about offering a truly self-directed account for a large company. For you to do things, if it's okay for you, your employees have to be able to do the same thing. So the issue with a truly self-directed 401k plan with a major company is you might have people that want to go buy all these different things, and if you just allow them to do it, the perception in today's world is you're incurring more liability, where if it's you or you and a spouse, hey, it's up to you and you can do what you want to do. So they're wonderful. Contribution levels, like I said, high 50 range, and it's to max it out, you're looking at income dependence. How do you do it with a 401k plan? Really, you're just going to write a check into that account. I mean, you're just going to move money into that account, and as I stated, with a solo 401k, you're going to have a bank account in the plan's name and EIN. You just move the money into that account. And address that. If you've got the 5,500 that you're filing, you're going to be addressing those things in that. Distributions, you're going to write a check out of that account directly. Once again, you don't have a trust company, so it's going to be direct in or out. And once again, a word of caution: if you just did this and you're under that 59.5, you're going to have a penalty there. But if you got that 59.5, you want to start taking distributions, by all means do it, and you can do that by simply writing a check. Or if you want to do it in kind, you're just going to be transferring whatever asset it might be, and you're going to need a hard valuation of those things if it's an in-kind distribution. So earlier we talked about this briefly when we were talking about objections that people have to a self-directed account. And they say, well, gee, lack of liquidity if it's real estate. You've got to take an RMD at 72. You don't have the cash to do it. How do you do it? And you're just going to take an in-kind distribution. So the wonderful thing in today's world is that, number one, you can do that. Number two, if you're taking an entire asset, you're going to need somebody to put a hard valuation. You might want an appraisal done. You might be required to get an appraisal done. If you're taking a minority interest distribution, that many trust companies don't require anything beyond a professional opinion value, that broker's comparative market analysis, that would typically suffice if you're talking about a minority distribution on things. But you need somebody that's an expert to provide some type of valuation. Now, what is the property worth? So obviously you've got a valuation opportunity there, and we talked about highest best use for things. So with real estate, it's definitely a variable there. So you want to make sure you and your tax people are on the same page with respect to valuation and what's going to be required and what they're going to want to see to support any in-kind distributions. Two, if you're looking at a minority transfer, minority distribution, you can discount that value by up to 40%. So if you're looking at, instead of taking an entire property out, you distribute maybe 20% of it over a series of years. Each of those distributions could be discounted up to 40%. Now that whole discounting strategy is used in estate planning all the time with gifting. And once again, I've got to point out that that's slated, it's on the chopping block with President Biden's tax reform. So, you know, I want to state that this presentation is being done at the end of August in 2021, and we have not seen what's coming out. So if you're watching this video, you know, heed a warning on this, on discounting on these valuations, because at the time of this filming, it's something that's possible. You know, if the reform goes through the way they're talking about it, looks like we've got numbered days on discounting. And, you know, as far as the effective timelines, you know, we really don't know at this point in time. So today, hey, by all means, use it. Whether you're taking a distribution or gifting things, if it's minority interest, you can discount it up to 40%. You want to make sure you're working once again with a tax professional. You're going to be, you know, I can't say this enough. I think your tax people are the most important people in your life in today's world. You know, outside your health professionals probably, but you want to make sure you're working with them hand in hand, proactively, not reactively. And you know, take advantage of their knowledge and you know, plan for an audit that you hope never comes, right? So make sure you're doing things in harmony with them. The downside of an in-kind distribution is really that you're incurring a tax liability without receiving the cash to pay the obligation. So if you just take a cash distribution, you know you're going to write a check with part of that. Part of it's going away. If you take a property out, for example, you've now, you know, triggered tax exposure, whether you're discounting it or not, you're triggering tax exposure without receiving the cash to pay the obligation. So you need to be aware of that, and two, have a source to pay that tax obligation. So a common strategy is to take the property out over several different distributions, and then contact your friendly mortgage broker and you know, talk to them about a cash out refinance of that property. You can use those funds to then pay the tax obligation that you've incurred. So that's a common strategy, and it works very well for people. And that same strategy could be used if you wanted to do a Roth conversion, for example. The same thing is being done. You're incurring a tax liability without receiving the cash to pay it. So that Roth conversion could be, the tax obligation triggered by it could be paid with a cash out refi of the property. Now, we need to understand that there's different tax obligations, whether we're talking about IRAs or 401k plans with leverage. We're talking about real estate. You know, basically, you're just buying property with the intent to hold for investment. That's the deal. And you can't buy anything that you or any other disqualified party is going to benefit from. So examples of investments you can make: rental houses, apartment buildings, office buildings, retail centers, land, any property acquired with the intent to hold for investment. You could not buy a primary residence, a home for a kid to live in, mom to live in, second homes. You can't use these properties in any way. So, you know, I get a lot of calls, people wanting to take their retirement account, buy a building for their business to occupy. We can't do that. The only way you're going to do that is if you're doing a rollover business startup, which is, once again, that's a whole nother conversation. So can you buy an office building? Yes. Can you buy an office building you're going to occupy? No. So it's just got to be something you're acquiring with the intent to hold for investment. And a future retirement home, you can buy that. You just can't use it until you fully distribute it out of your account. So you're going to, once again, look at those in-kind distributions. And until the law changes, I would encourage you to look at minority distributions over a number of years and apply the discount that's there. So if we're looking at, you know, we talked about what you can buy. We talked about, you know, those two issues. What are you buying and who you're transacting between it for the benefit of? This slide just talks about examples of prohibited transactions. So if you're in the IRA world, any of these is going to trigger an entire distribution, all funds in the account, and that would be borrowing money from your IRA, selling property to your IRA, unreasonable compensation for management. I would say no compensation for management. That bullet's on there. My legal people say, well, gee, you can't have sweat equity in a retirement account, so maybe you could have a little bit of compensation. I would say don't do it. I don't ever want to see a check between you and your checkbook IRA LLC ever. I mean, if you want to take a distribution, like I said, the money's got to go from the LLC through the trust company to you. If you're making a contribution through the trust company to the LLC. The only check or transaction between you and your 401k plan would be to make a contribution or take a distribution, but no yield, nothing else is going to be between you and that account. The cost of a prohibited transaction is very, very high. It really, with an IRA, you've in effect distributed all funds in that account as of the first day in the year in which the indiscretion occurs. So you do not want to commit a prohibited transaction, period. 401k plan, totally different ramification. It's only the funds involved with that indiscretion would be treated as a distribution. Mortgages, just got to be non-recourse. Meaning that in a default, the only thing the bank can take is that property, cannot go after you. Typically, a loan in this space is going to be maybe a max of 65% LTV. They're going to want to see maybe no less than 15% reserves, and they want to see somebody that's got some experience with the asset class they're financing. They don't want somebody getting involved for the first time and going out and getting a high leverage loan. So once again, you're going to be in a situation where you got to have the reserves there. And with that self-directed IRA, understand also, and this is not a reason to make or not make a given investment, that you're going to have tax exposure on any income or gain attributable to the leverage, where the 401k plan you don't. I'll say that again. If you buy property with a loan with an IRA, if it's 50% loan to value, half the income and half the gain you would realize on disposition would be taxed. The equity component is going to have the tax deferral or tax-free treatment that a Roth would offer, but income or gain attributable to other people's money is going to be taxable to you. That's something that people just don't understand. If we're talking about a 401k plan, that is not the case. 401k plans do not have tax on leverage. That's one of the reasons that we really like them. A few examples, and then we're going to wrap it up. So it looks like we are done with the hour. If you go, I understand that, but if you can stick around for another 5-10 minutes, we're going to get through some good examples I think you will find helpful. So this first example just talks about somebody looking at diversification. That's a primary reason people want to do these self-directed accounts, is they just want to diversify outside Wall Street's offerings. Now, this gentleman, had the ability. He had a friend that was having problems. This was over a decade ago at this point, and this was the last recession. So he had a friend that had done a subdivision near the beach. Was having a problem selling them because nobody could buy or sell anything. So he said, look, I think at this price point, it's going to be a great investment for my retirement account. I'll buy and hold it. And it's also I have the ability to help my friend. And so it was a compassionate play too. So this gentleman, self-directed enough. It's not all or nothing. He's self-directed enough to make the investments he wanted to make initially. And then over the subsequent years, he started asking about different things our clients were investing in. And ultimately, he ended up moving a lot more money through us, self-directing into a variety of real estate transactions, and has done very well with that, very happy. And with what he did with the ultimate diversification, he obviously kept a large pool of Wall Street investments, but he moved enough into the real estate world where he's got nice balance there, and he's got a nice portfolio of hard assets at this point in time. This example is sort of looking at a situation where we're talking about what you're investing in, but who you're transacting between or for the benefit also. And in this scenario, we had a builder developer again during that last crash, wanting to take his retirement account to land bank. So he wanted to buy a bunch of property that was literally dirt cheap in those days. And he didn't know when he was going to be able to build on those lots, so he didn't want to go borrow money from bank and go pay those carrying costs through a period of time until he could develop it. The issue that land banking with a retirement account creates though for developers, you can't buy, so any transaction between or for the benefit of disqualified party once again constitutes a prohibited transaction. So he couldn't land bank with the retirement account and then build on that with his business, his development company. That would constitute a prohibited transaction. He can't, furthermore, he can't have that business, that development company buy from the retirement account. So what we did is we created a second entity. We created another limited liability company, and his ownership in that second limited liability company was reduced to 1/6 interest. So that entity would then take over, buy from the land bank entity, go vertical on it, and then sell it. And that land bank entity, when they got the funds from the sale, would just go forward and buy more property. So by once again crushing his ownership interest down to 1/6, that LLC was no longer a disqualified party to his retirement account. Therefore, that transaction was no longer a prohibited transaction. So it worked very well for him. Another example would be this gentleman. I love this guy. Actually, unfortunately, he's since passed away, but he was just such a joy to work with through the years. And he first reached out, and he just had so much energy, and he had lots and lots of real estate. He was tired of the terrible T's, toilets, trash, tenants, turnover. He first reached out because he was thinking about taking retirement funds, buying a mobile home park. My comment on terrible T's might not make sense with what I just said, but that led to a call the next day. So his initial call was, can I do this with the mobile home RV park? The call the next day was, can I take my retirement account and go buy notes and make loans? And once again, the answer was yes, you can do that. And so ultimately he shifted away from the real estate and ended up making investments in notes. And the numbers involved, think about it, that last crash, he had what had been a $250,000 property that somebody was buying for $70,000. All he needed was $35,000 loan, 50% loan to value, paying him 11%. He was very happy with that, and he joked that he'd love to see him default and end up owner of the thing for that investment, which would be a great situation for him. Obviously, we don't want to have people losing things, so. But it was just chuckling about it. Now, he's another guy that has sort of dipped his toe in the water with this process. He did this first transaction, then he moved more money in as more notes were available. He had somebody he worked with regularly, and ultimately he moved in excess of probably a couple $1 million through us, all in notes. And the last note I remember him buying was for a wind farm, and they basically only needed, I think it was a $10 million item, and they only needed $1 million out of it. So he had a 10% equity, and in that case, it was paying him 19%. So in that scenario, he truly did hope that they defaulted and he'd end up with the whole thing. But once again, I think I've had discussions with good buddies in the commercial real estate world, and I'll never forget, actually, one time we were talking about notes, and he had a company out of Texas, actually, that was doing hospitality notes, and it was really interesting because he had organized a group of, commercial real estate professionals, and people think they own things. You don't own it until you've paid it off. The true owner is the bank until you pay the thing off. So, some of the brokers that were in that first meeting kept saying, well, gee, what happens is that if the mall goes dark, and they can't make the payments? Well, okay, you own the property, you own the mall. So, in this guy's case, he got to a point, he didn't want to deal with terrible T's. The notes were a great solution for him, and I believe I've got, I saw a list of people on this call today, and I know at least one of the people on this call is very active in that space, and you'd probably echo similar sentiment. This is a bailout, and this is a way that not everybody might agree on this strategy, but this is a situation. The last crash, we had a builder developer that had, and I put this example up because I'm just thinking, hey, we've got a very frothy market right now with all the, instability in the world and all the money that's, being proposed to be spent. Obviously we're going to have inflation. We've had a lot of inflation over the last, 8 months, but in this case, we had that catastrophic collapse of the economy. And this gentleman had a loan, on a $3 million property, $1.2 million loan with a bank that was failing. The bank ultimately did fail. He was concerned he was going to lose the asset, and he didn't have the money to, pay it off. So, he called up initially, can I use Dad's IRA to pay this asset off? The answer is no, you can't do that. That would constitute a prohibited transaction. So, what we ended up doing is taking a whole different path, and before you venture forth on this path, I'd get you some information, but you want to talk to your tax and legal people about it. But what we did in this scenario is we created a new limited liability company. The builder, Junior, contributed the property into that limited liability company. Now you need to have a hard valuation there so we can substantiate the actual equity that was contributed. So in this case, it was deemed that he had a $1.8 million cash contribution, when he put that property into that entity. Now, at the same time that happened, we did a checkbook IRA for Dad. So Senior, we moved his, we moved a chunk of his money, a couple $1 million, into that LLC as well. It wasn't a couple $1.5 million or something like that. But what happened is by creating that new limited liability company, Junior put the property and received the membership interest attributable to cash. Senior had his IRA make a cash investment in the LLC, which now meant that the LLC owned the property and had the cash to pay it off, and that's how we got it done. So, I hope we don't ever end up in a situation again where we're having to use this strategy, but it's something that has worked very well historically, and I see no reason you couldn't do it going forward. But it's something that we want to have a good conversation with you and your tax and legal people before we go forth with that structure. This is a situation where we had an elderly couple. If you've been to my classes before, I always give this example. This is a couple that came to us wanting to use their IRAs to go buy a mobile home RV park. And they didn't mention anything about working there or living there. So we looked and went through it with the idea we'd do a checkbook IRA with his account and her account. So once again, we'd move her money from whatever trust company it currently was into the new trust company, his money go from whatever trust company into the new trust company. So we'd have two different trust company accounts, one for him, one for her. Each of those accounts, once again, are disqualified parties to each other. They would make the investment in the checkbook IRA LLC simultaneously. Now you've got the LLC, which would have then gone forward, bought the park. Well, that would have taken care of it if it was an investment. They didn't. What we ultimately found out is that they wanted to work there. They wanted to be on-site managers, take compensation, work there, and live there. That won't work. So we shifted gears into a rollover business startup. So we moved both their IRA funds into a new 401k plan. The 401k plan bought the corp. It has to be a combination of 401k and a C corp. The corp bought the park, and they got an investment, they got a job, and they got a place to live, all with that one transaction. So never say never. Finally, this is a situation where we're combining 1031 funds and qualified IRA money. So in this transaction, we've got a group of investors we've worked with for, I don't know, probably 25 years, and they were giving up a large asset, tenancy, and common ownership. So the property went away, and we had some 401k money in there. The 401k money is what I call patient money. So anyone on this call that's done an exchange knows the toughest thing about any exchange is time. And so what we did in this situation, we were doing an improvement exchange on the acquisition side too. So what happened is we used tenancy and common structure on phase one, the liquidation of the property. We acquired the replacement property, went vertical on it, and the qualified money, the 401k money, and actually future IRA money too, we keep out, use that money to do the improvements. And then when we burn through all that, now the qualified money, the 401k in this scenario, had a note which was then, to that tenancy in common group. Now, the idea was going forward, the TIC would be contributed into a new limited liability company, and those notes would then be converted into a membership interest for that qualified money, and now everybody ends up owning the asset. The reason we used a TIC structure initially is that 1031 requires that. 1031 prohibits the exchange of partnership interests. So using the tenancy in common structure on acquisition allowed the 1031 to be completed for all those in the 1031 space. The qualified money, like I said, came in as debt for them. And then when the contributions into the entity were made a year downstream, the notes were converted into a membership interest too. Now you go forward several years and they're unwinding it now, and it's going to be dropped back into a tenancy in common so that people that want to go away can go away, and the balance that want to go forward can go forward via 1031. And just as the 1031 funds end up ticked out, we can then tick out the qualified money as well too. But this is just an example of what's possible. This took a lot of time to put together, and ultimately I think it was about a half dozen year project overall. But we got everybody where they wanted to go, whether we're talking 1031 funds and or qualified IRA 401k money. So, IRA investors checklist. Plan ahead, takes 2 to 4 weeks to establish the account. You can purchase all types of property with an IRA, SEP IRA, Roth IRA, purchase with family member and friends. You cannot purchase from or for them. Your IRA cannot sell to you or any other disqualified party. You can use an IRA to buy property with a mortgage. Negotiate from the deal's inception in the IRA or IRA LC's name. Do not overextend. Plan on keeping a nice cushion for reserves. Real estate is a real investment. Thank you very, very much for joining us today. This is a few of our contact information. You're going to be getting this from Celia. And please, if you're on YouTube and you want to watch this at some point, you'll receive a link for this, but please like and subscribe. It helps us out, and we really work hard to give you information we feel is timely and helpful to you in life. If you've got a subject that you would like to know more on with respect to IRAs or real estate, 1031s, please don't hesitate to reach out. We're always looking for great topics, and we want to answer the questions that you've got. Thank you very, very much for your time today. Best of health to all. And David Moore, Equity Advantage, IRA Advantage, IRAadvantage.com, 1031exchange.com. Thank you. Take care. Bye-bye.